Okay, here we go. We're going to look at accounting for a merchandising business. Um, it's a little bit different, and it just adds a couple of new accounts. And this is what we've been doing. We've been looking at a service industry. Whoops, I can move it around. How about that? Been looking at a service business, and that's where you had the fees earned, and then operating expenses, and then you had net income. Well, now we're going to pull it out a little bit. A service industry doesn't sell product. It just sells a service. But a merchandising business sells a product. So they're going to have sales. They're going to have a cost of goods sold, or a cost of merchandise sold. And instead of a net income here, you're going to have what they call gross profit. Then you're going to subtract the operating expenses to get the net income. Just a little bit of an add. This cost of merchandise is how much inventory you've sold. So it kind of looks like this when you look at the nature of it. You have cash. You do a purchasing activity, which means you go and you buy your product. Let's say you're Walmart. And you've got this cash and you're going to sell widgets. So you go and buy widgets. Those become your products. And then you sell them. And in this case, they show accounts receivable. Walmart would show cash in most cases because of the credit card sales. They would collect the cash and the cycle would start all over again. So this purchasing activity right here is what's been added to the cycle. And that changes our chart of accounts. Our chart of accounts kind of get, see the things in pink here and here. So on the asset side in the balance sheets, it's going to add merchandise inventory. We usually don't have that because we've been doing service. You've got all the other suspects here. You've got office supplies. You've got store equipment. Here's your accumulated depreciation. Liabilities are the same. And owner's equity is the same. On the revenue side or on the income statements, you've got sales. You're going to have sales returns, because remember, you're selling merchandise now, so people can bring back the product. And you may have sales discount, because if somebody buys on their account, sometimes you give them an incentive to pay it off early, which is a discount. In the expenses, you now have cost of merchandise sold. And you've got an added expense down here called delivery expense. So your chart of accounts is fairly similar. We've just added some new accounts to it. So if we now, let's look at some financial statements, because that's what we're concentrating on now. We've been doing a single step income statement, which means you've only got two columns. You put your sales here, you put your rent revenue here and add it up. Then you put your expenses in the left column and subtract it and get a total. Fairly simple. Well, we're going to be doing what they call a multi-step. Did I miss one? This is called a multi-step income statement. And it has three columns. Here's the revenue. Here are your deductions from the revenue, and they get added up here, and the total goes here, and your final total ends up in the far right column. So you'll start in the middle, you'll do your decreases here, you'll put the full decrease amount here, and subtract it here to get your total net sales. Let's look at the full thing here. Here's a full income statement. Now, if you remember, we used to have revenues, and then we had rent revenue, and right up there with it. It's been separated out now. So not only do you have the three columns, they've taken out revenue that's really not related to the business. That's an aside revenue. So now we have sales. We have sales returns, somebody brought some stuff back, and we have discounts. for a total of 11,930. And we had gross sales right here of 720,000. We're going to subtract these to get our net sales. Then that cost of merchandise sold comes into effect. That's going to be subtracted right here, because that's already added up, so that's going to be a direct deduction. So that's kind of the big change you're dealing with. Other changes you're dealing with are going to be, see the cost of goods sold, this gross profit, that's a new term you're going to be using. The gross profit is your net sales minus the cost of goods sold or the cost of merchandise sold. And then your selling expenses, administration expenses come down. Notice here, let's go down one more. Notice all of your expenses are in the far left-hand corner. They're added up by category, and the totals put in the middle. And this one's added, and the totals put in the middle. And then these two are added together to get your total operating expenses right here. And then they say this is income from operations. So we're just kind of changing titles a little bit. Then on the bottom here, you're going to do other income and expenses. Other income and expenses are income and expenses that aren't related to the operations of the business. Like typically you're not in the business of rent, or typically you don't receive interest is not part of your business plan. It would not fit in up here under selling or administrative costs. So this is a multi-step, and we're going to be doing one of these when you get into class, so look at this very carefully. These pictures are in your book. So, and I should have put the page numbers, but if you look in your textbook, you're going to find these very same pictures that you can use for examples. Let's move down and look at the statement of owner's equity. Now it hasn't changed. You've got two columns, and that's what you've had in the other one. You'll start with your capital. You've got your net income for the year from the income statement, less the withdrawals, and there's your increase right there. And now let's look at the balance sheet. See, your balance sheet's got three columns. Again, you start right down the middle and add up all of your current assets, just like this. Put the total here, and then you do your long-term assets or your non-current assets. Same thing, you start in the middle. That's a major category. Then you've got the store minus the depreciation. See how that ends up over here, netted. This one's the same thing, netted here. These are all added up and put right over here. It gives you your total assets. Same thing with your liabilities. Your liabilities start in the middle, you add them up. The total, ending total, goes on the right. Here's a note payable. Nothing to add here. It's just going to go right in there. There's your total liabilities. And then here are your owner's equity. So there's not much change in the balance sheet or the owner's equity statement, but the income statement looks different. And if we come down to the next one, of course your adjusting entries are going to be just a hair different, because you're going to have to make an adjustment for the inventory you're now carrying. And every year or every period you're going to go out and probably look at that inventory and count it and see if what you have on the books, which is this, right here, was available, that's on your accounts, actually matches. Now in this case it didn't. There was 62,000 instead of 63,000. So there was a shrinkage, or we've got to adjust the inventory. So that's an added adjustment, and what that would look like is an adjusting entry of cost of goods sold. We're going to increase that because we're $1,800 short. So we're assuming it was we sold it, didn't know it just got lost in the bookwork, or somebody stole it. So, and then we are crediting the inventory to get it set up correctly, and debiting the cost of goods sold, which we go into the adjusting entry. And the rest of your adjusting entries then would be the same type that you have that we've been doing. Closing entries look just a hair different. Here's your sales and your written revenue. That's going to close out the same. When you go to do closings, though, you're going to have to add the sales return, the sales discount, and the cost of merchandise sold. And then everything else is the same. These really act just like expenses. They deduct from income. The sales return, the sales discount, and the cost of goods sold. Let's pull this down one more. And here's your summary, income summary. That hasn't changed. And finally, the draw account. That hasn't changed. So basically, as you look at this, the main difference of the balance sheet or of your statements are going to be on your income statement, where you have the sales returns, the sales discount, and the cost of merchandise, and then switching to this 3-column at the multi-step. But I think overall you're going to be fine because they're plug-in chugs. And we're going to do problem 6.5. So give that a look, and we'll talk about it in class. Thank you. Have a great day.